I'm Yahoo Finance Executive Editor Brian Sozzi, and you're taking a look at a live shot of the opening bells on Wall Street on this Monday morning. Really ringing the bell at the NYSE. XCF Global getting things underway at the NASDAQ. Markets are getting back some ground after the rip-roaring rally on Friday that ensued after Fed Chair Jerome Powell's Jackson Hole speech. Powell acknowledged the Fed was in a challenging position ahead of its mid-September meeting as the job market has slowed, yet tariff-driven inflation lurks. Still, Powell opened up the door to a rate cut in leaning toward showing more concern to a labor market showdown. Let's get a pulse on the markets after that sizzling Friday session. Yahoo Finance senior reporter Brooke DePalma is standing by at the NASDAQ in Times Square. Brooke, we're still watching the Fed commentary, but we're inching very close to that Nvidia earnings report midweek.
We absolutely are. That'll be a key indicator for how exactly the second half of the year plays out. There's lots of momentum behind what exactly those results will be. If you take a closer look, all three major indices opening up this morning, a bit of a mixed picture here. We have the Dow under pressure, down about 0.2%. We have the S&P 500 down nearly 0.2% as well. And the NASDAQ continuing that momentum that we saw on Friday, up nearly 2% at the open. If you take a closer look, I also want to point out that the top trending ticker this morning on the Yahoo Finance page, one of them being Intel, and that's largely because the U.S. government announced that they would take a 10% stake in the company over the past 2 days. Of course, this announcement happening just last week. It's up more than 8%. And President Trump taking to Truth Social saying, quote, "I love seeing their stock price go up, making the U.S. richer and richer." We know that this move largely has to do with the U.S. vying with China as it comes to the AI arms race. But once again, a mixed picture here at the open as we kick off this week's trading session.
All right, thanks so much, Brooke. Appreciate it. In today's Power Player segment, we're digging deeper into all things Federal Reserve and the economy at this important juncture for each. Lawrence Summers is a Charles W. Eliot University professor and president emeritus at Harvard University, and of course, former U.S. Treasury Secretary. Mr. Summers, always nice to get some time with you. Thanks for hopping on this morning. Look, so markets are still very much focused on what Fed Chair Jerome Powell said at Jackson Hole, leaning more towards concern about the outlook for the job market. I would love to get your assessment on what we heard from Powell.
I think the markets probably read it right in terms of what he laid a groundwork for. I'd say I remain very much agnostic on the relative likelihood and relative danger of inflation and unemployment. I worry that it's now been years since we really had a sustained period of 2% inflation, and that we probably haven't seen all the consequences of tariffs. And we're seeing probably more pressure on politicization of the Fed than any time in generations. So I think it's a moment actually to tilt towards concern about maintaining confidence in the long-term commitment to price stability. So I would be hoping that the Fed will continue to be very much data dependent and watching very carefully what happens both on the inflation statistics and on the unemployment statistics, because I think we do have some stagflationary impulses working through the system.
Part of the reason why the market rally so aggressively after this, Mr. Summers, of course, is the view that the Fed may continue not only cut in September, but offer up a series of rate cuts. If they were to do that in line with what the market may be thinking, does the Fed risk losing price stability?
You know, I don't think these judgments can be made with any confidence till we have more data. That's why I would prefer a much more agnostic posture from the Fed that expresses less conviction about what it's going to do in the future and only emphasizes its determination to respond to incoming data. It may well prove out that there's a significant case for rate cutting, but given the strength in asset markets given that you can have tightness in labor markets even with relatively limited employment growth, given the reductions in immigration pressure, and given that you're going to see a set of price increases in all likelihood associated with the tariffs. I'm not sure which side the balance of risks is really going to point. So I'm not prepared to say that the market forecast is out of line or won't materialize or shouldn't materialize, but I would judge the balance of risks to point a bit more towards maintaining inflation, anti-inflation credibility than was my reading of the chair's speech.
We have seen really an upending of global trade under the Trump administration. Of course, with these tariffs, you also have the one big bit of beautiful bill. You've been critical of this. If you and I are having this conversation a year from now, that bill starts to kick in, the tariffs start to kick in even more, infiltrate the economy. What does inflation look like under that scenario, let's say a year from now?
You know, everybody wants specific forecasts in a world where there's huge uncertainty about what future policy will be. And quite apart from policy, there's huge uncertainty just as to how the economy is going to evolve, particularly given the huge upsurge in investment in data centers. I'm reasonably secure in the judgment that we're going to have more inflation than we would if we didn't have these substantial tariffs. And I'm reasonably confident in the judgment that probably they're also deflationary or contracting of the economy, I meant to say, because they represent a tax increase and an important source of uncertainty. So their effect is going to be negative, but what would happen in their absence is very hard to judge. So I don't want to make a specific forecast. I think the biggest medium term risk is that we are never going to achieve a successful, sustained return to 2% inflation. And I think if that happens, there will be a general erosion of the Fed's credibility, which will make macroeconomic management down the road more difficult. And I think the evidence from voting behavior and from surveys is pretty clear that whatever some economists may think, the American people really don't like significant inflation and don't like what it accumulates into in terms of higher prices. So I would be placing more concern on that side than I think some in the markets are or some on the Federal Reserve Board are.
It's not lost on many, Mr. Summers, that this signal by Powell on rates comes after, really, he's been taken to task. It hasn't been an easy summer for the Fed chair in terms of that relationship with the president. Of course, the president calling for lower interest rates. Has Jerome Powell put back into question Fed independence?
I've got huge confidence in Jay Powell's integrity. And look, there are a lot of actors, universities among them, the Fed, who face a situation where they're pressured by the president in an illegitimate and unreasonable way to do things they might have wanted to do anyway. And so I don't think institutions under pressure should stop doing something just because the president is being a source of pressure on that thing. So I would tilt a bit differently, not a huge amount differently than Chairman Powell, towards agnosticism about inflation versus unemployment risks. But I don't think that he's acting the way he's acting because of political pressure. I think he's acting that way out of conviction. I have great respect for his integrity, even at moments when I have had disagreements with him. And I have to say that the use of prosecution of one's adversaries, whether it's the FBI visit to John Bolton's home or whether it is the kind of attack that has been launched on Lisa Cook, is, I think, something that should be chilling to many Americans. And I'm disappointed that we've not heard more expression of concern from, for example, the business community, because I think if there's a norm that all kinds of pressure tactics are legal, including bringing the power of law enforcement and investigation and demands for resignation to bear, if that becomes the new norm in American politics, the way intercession redistricting is becoming a norm, if we see a erosion of our norms, I don't think that's going to have big effects immediately economically, but over time, what you might call the Argentinization of the United States is something that I think is a very profound threat.
Mr. Summers, if Lisa Cook, Fed governor, is in fact fired, how should a lot of the CEOs or corporate America view a move like that? What is the longer term ramifications of that?
So I want to be clear that I don't know the facts of the case. And obviously, any judgment has to be predicated on the facts. But for a regulatory official to be demanding the resignation of an official outside of the purview of their regulation, as Mr. Pulte did, on the basis of data and information that they presumably got from within their regulatory authority, is, I think, something that's close to unprecedented, at least in recent years in the United States. And if you start seeing regulators who traditionally have regulated with respect to rules as prosecutors of individuals, I think that precedent, that norm, potentially could be weaponized in many, many different ways and directions against business people by people with all different political convictions. And I would hope that there'd be expressions of concern from the judiciary, from the business community, from people of goodwill everywhere.
Mr. Summers, before I let you go, you have a very unique view on the future of technology and AI sitting on that OpenAI board. What do you think about the government taking a 10% stake in Intel? Is that a good move and one that you want to see?
I'm surprised by that move. I don't know the details of that situation well enough to understand the transaction. I can certainly see the logic of the government wanting to get something back for taxpayers when it supports a company that has been poorly run. But it comes as part of a general approach to policy, what you might call deals-based capitalism rather than rules-based capitalism. The rather remarkable and I think extraordinarily problematic transaction with Intel, where they were given more export controls, freedom in return for payments to the government, the taking of a share in US Steel as the price of granting a regulatory approval, the deals struck with law firms after threats against those law firms not to be able to enter government buildings. The whole approach of deals-based capitalism is, I think, something that is really quite problematic. And I would guess that when I learn all the facts, I will find this Intel transaction to have that aspect as well. But I don't want to judge the transaction, given that the government is bailing out a company that has been poorly run without understanding things better.
All right, we'll leave it there. Former US Treasury Secretary, Mr. Lawrence Summers, always a treat to get some time with you. We appreciate it.
Thank you.
All right, straight ahead, the dust has settled on Walmart's mixed quarter. And one analyst says now's the time to buy the dip. I'll have more on that and look ahead to Nvidia's must-watch earnings report. Welcome back to Opening Bid. Walmart's less than perfect second quarter got the bears out of hibernation on the stock, but Evercore ISI analyst Greg Mellick says the pullback is an ideal buying opportunity. Mellick sees Walmart's fair value at $110 a share, about 13% higher than current levels. Says Mellick, Walmart is winning share and driving top-line volume while also investing for the long term via price, in-store service levels, and omni-channel prowess. All right, it may still be summer, friends, but don't think this week will be on the slow side for markets. Actually, quite the contrary, especially after Fed Chair Jerome Powell signaled a potential September cut in rates. Here's what I'm watching right now. Number one, it's about the path, people. The market didn't rip higher on Friday because Powell opened the door to a September rate cut. It rallied on the view Powell will deliver a series of rate cuts before he heads out into the sunset and probably does a book in 2026. But is that the right bet? We'll discuss. Number two, Nvidia on the clock. The street is super bullish on Nvidia into earnings on Wednesday. Price targets have been gone up across Wall Street, and most are banking on robust guidance. Analysts think Nvidia will show a rebound in China sales and at the same time continue to benefit from AI infrastructure buildouts in the U.S. Given the high expectations, Nvidia has to deliver big time or the broader market could get drilled. Number three, Intel's drama-filled summer. Intel will now have the U.S. government as a 10% investor. This not long after CEO Lip-Bu Tan was shredded on social media by President Trump. While Wall Street seems to like the Intel tie-up with the government, it only papers over a huge ongoing issue. What Intel is selling isn't on par with rivals. On the Opening Bid roundtable to chat about all this stuff, stockbrokers.com Director of Investor Research, Jessica Inskip, and Yahoo Finance senior reporters Brooke DePalma and Inez Ferre. Jessica, good to see you. I don't know if you were able to catch my chat with former Treasury Secretary Larry Summers, but he was pushing back on the view that we might see a series of rate cuts out of Jerome Powell. Would you agree with that?
Yeah, well, I want to take a look at the price action, and I think there were some interesting statements that we can take away with that. So even with inflation unfinished, Powell had a dovish lean, or at least that's the way the market seemed to interpret it, and that drove some curve steepening and nominal yields, but there was also dollar weakness. So from the price action standpoint, there's something that I've been watching for quite a long time, which is the S&P 500 equal weight. We actually cleared the ceiling of uncertainty, which was around 76.12, which was the high on November 25th. We haven't made a high with the S&P 500 market cap weight with the equal weight since that date. So that's a major hurdle for the market, something that now will be support. So I'm watching that for follow through. But as far as action, when we want to look at how the market feels about it, I like to look at the yield curve. And short-term bills, they really barely moved, which might suggest, due to your previous interview, there might be some steady holding within the immediate term. However, the bulk of the move, and actually the largest was 11 basis points, if we just look at the difference of right before or the day before he spoke and then where we closed after Powell spoke, was in the 2 to 5 years. There were the largest declines there. This is where policy expectations tend to be most sensitive. And so that sharp drop suggests that perhaps we have a higher chance of the Fed easing sooner than before, but not necessarily in the immediate term because of what happened in the short bills. And I thought was interesting on the long end, they're really stable, which means to me, investors still believe inflation, it's going to be contained over the long run, but perhaps that's more fiscal policy that's being priced in as we see this change in dominance of fiscal policy within the market more than we've had in a long time.
Inez, none of this may matter if Nvidia doesn't come out here and blow it out of the water. Not only in terms of its earnings report later in the week, but that conference call has to be damn near perfect.
It absolutely does.
Inez,
yeah,
go ahead.
Yeah, it does, definitely. Look, Nvidia is what everyone is now looking at as far as the market catalyst is concerned, and whether Nvidia beats and also raises what Nvidia says about the H20 with respect to China, and what Nvidia says about demand from the hyperscalers as well. All eyes are on Nvidia and the AI trade, which is really what Wall Street believes is going to be propelling the markets and the economy forward.
Brooke, it was so interesting to hear Larry Summers. Of course, he sits on the OpenAI board, has a unique view into all things tech, push back on the notion that this government deal with Intel is great news for Intel. The market thinks it's great news, but maybe it's not.
Yeah, right now what we're seeing is Intel continuing gains that they had on Friday. If you take a look, it is one of the top trending tickers on Yahoo Finance this morning, especially after President Trump took to Truth Social to continue to excite investors, saying that he loves seeing the stock price go up and also that it would lead to more hiring here in the U.S. We are seeing intraday down roughly flat, but over the course of the past 2 days, that 10% stake from the U.S. government in Intel certainly got investors optimistic about the outlook for this company. In the last 2 days alone, it's up more than 5%, and over a month to date, it's up nearly 27.5% over the course of the past 15 days, according to the YF Interactive. And so it's been interesting to see this saga play out when it comes to Intel stock and the exact moves that it's had because of the way in which the U.S. government is playing into it.
Jessica, is Nvidia still the best way to play the AI trade? Or at this point, we know everything that Nvidia does. We know that the conference call earnings will likely be strong, and now is the time to rotate into some derivative trades.
Yeah, so I think Nvidia is still a primary beneficiary of this entire AI narrative. As far as loading up into it prior to earnings is never a good idea. And from a portfolio perspective, tactical asset allocation is always going to be king. However, Nvidia is absolutely going to be telling with the AI narrative. A big tech spends so much on AI infrastructure, and it's this game theory. Everybody wants to be in the game. There is this race to artificial general intelligence. Now it's called artificial super general intelligence. There's so much spending within the hyperscalers and this mega team that Meta's even putting through. But no matter how much they spend, the beneficiary of that, or one of the beneficiaries, is Nvidia. So seeing how that follows through with earnings within Nvidia is very important to this AI narrative. And I think there's more than just what Nvidia does is well beyond GPUs and chips. They have a moat, and they're ever increasing that moat. And that, to me, could be a next catalyst. If they have a deal with a data center where they could provide that, where if you are purchasing CPUs, sometimes it has to come with certain other things that you may not need at the same time. So therefore, you're spending and not getting enough for your dollars. But if you can have more efficiencies, Nvidia, these are whispers of these type of deals. But if something like that comes through, then that increases the earnings potential. But Nvidia has done that with every layer. They have hardware, they have software, they have supporting cost. Once you invest in an Nvidia chip, you also need Nvidia to keep updates, and there's continuous service revenue. So I think it's still accelerating. There is a larger total addressable market that's just ever increasing. But in the short term, we need to pay attention to demand.
All right, bring on that Nvidia earnings report. I'm psyched for it. I know y'all psyched for it. Thank you to my opening bid roundtable, Jessica Inskip, Brooke DePalma, and Inez Ferre. Talk to you soon. Coming up, Ali Canal has you for Market Catalyst. Don't go anywhere.